Today, when we talk about troops, we're talking about sending them in after we've negotiated a lasting peace. And once we have that solid, lasting peace, that's part of an agreement signed by Ukraine, signed by Russia, and for which we will provide the guarantees. Then at that point, and recently France has worked with the UK to provide its contributions. We've worked on plans, we've worked with our militaries, not to go to the front lines, not to go into occupied territories, but as a show of support to show that we have a negotiated peace signed by both sides, and that is a peace we will preserve. So these would be peaceful deployments of troops, not for combat. These would be deployments of an assurance force. They would be limited, but they show solidarity. I've also spoken with all of our allies, and there are European and non-European allies who are ready and willing to take part in that effort. Countries have helped Ukraine maintain its military capabilities in terms of the number of soldiers it has, equipment, whereas others have provided logistical support on the ground. The question is whether or in what form the U.S. will contribute, and during our discussions, and during the discussions with Russia, we've understood that this would be acceptable to Russia, and that's a very important area of progress. And that means that in this context, the Europeans will shoulder their part of the burden, their share of the burden. We have a strong alliance that we've built over the decades. We have our solidarity, and we have deterrence capacities. What does it mean? Would it be dangerous? If there is an agreement signed by Ukraine and Russia, thanks to the efforts of President Trump, and if we provide the guarantees and Russia violates the agreement, then it would be in conflict with everyone who is engaged in the peace process. And that is a change. That was something we did not see in the past. That's not what we saw in 2014.
And you're watching French President Emmanuel Macron standing next to his U.S. counterpart, Donald Trump, at the White House in Washington, D.C., as those two world leaders seek to reconnect here. A new administration in the United States with a lot of big implications for that relationship between the U.S. and France, and more importantly, the U.S. and Europe. Romaine Bostick alongside Alex Steele. We want to bring Spencer Boyer into this conversation right now. He's a partner over at the DGA Albright Stonebridge Group, helping to lead their main practice here that focuses on national security and defense. And prior to that, he was the Deputy Assistant Secretary of Defense for European and NATO policy. And Spencer, I do want to start off with the relationship between these two men and how strong it is in your eyes.
Between President Trump and President Macron, or President Zelensky?
Trump and Macron.
Well, I think that this was a positive press conference. Clearly, President Macron is acknowledging the efforts that President Trump is making to try to find peace in Ukraine and to end the conflict between Russia and Ukraine, with Russia obviously as the aggressor. I think we all appreciate that and can all agree that we want the bloodshed and the destruction to end. So that's all positive. Obviously, President Trump has been very clear about what his goals are with regards to the relationship with Ukraine, and talking about what he is hoping to get in terms of critical minerals, rare earths, and viewing it in a bit of a transactional way. I think the Europeans approach it differently. So we'll see how things develop as this peace process unfolds.
Spencer, what was so interesting from Macron was he was talking about smooth trade, how the economies are very intertwined, how they will carry on economic discussions. That wasn't part of this conversation at all. This was about Ukraine, and he was the one that brought in the economic ties. And I'm wondering what the relationship you see as to defense, Ukraine and Russia, and the economic ties and the tariffs when it comes to Europe and the U.S.
Well, certainly President Trump and President Putin are very focused on a broader relationship between the United States and Russia and rebooting that relationship. so that there are economic benefits on both sides. If you look at the meeting in Saudi Arabia last week, and the news headlines were very much about the peace deal that was developing, but it was much broader than that. It was about reestablishing diplomatic ties in Moscow and Washington, and reestablishing diplomatic staff. It was about the broader economic relationship, closer relations across the board, and about how to ramp up the peace talks. But both sides are viewing this in a way that can provide economic benefits. And again, in terms of looking at Ukraine, whereas our European allies, and certainly in the last administration, we were very much viewing our support for Ukraine as being about European security, and European security being critical to U.S. security. President Trump is viewing this in a different way.
Yeah.
He is viewing this as a chance to recoup some of the aid that we've given to Ukraine.
Yeah.
And that's the way he wants to move forward.
Well, that's the way he wants to move forward. It's not his country. And Zelensky was not a part of those talks before. Zelensky has hinted that he might be a part of those talks in the future. But at least based on what we've heard from the Ukrainian side of this, they haven't actually been offered anything. They've been asked to give up a lot. I'm not sure they've been offered anything. Have they, Spencer?
No, I don't think that they've been offered much. I think that is one of the unusual aspects of these negotiations is that the U.S. started with Russia, which clearly is the aggressor in this context. And a lot has been asked of Ukraine in terms of what it might need to give up in terms of territory to move forward. As was discussed, what might need to be given in terms of rare earths and critical minerals in order to have our support going forward. What we are not probably going to allow in terms of NATO accession, and what the limits might be for any kind of U.S. presence on the ground as part of a peacekeeping effort. And President Macron talking about what Europe might do, but not a lot in terms of what the U.S. might do.
Yeah.
And not much asked of President Putin. And I'm afraid that President Putin likes that. He likes to demand everything and give nothing.
Spencer, we very much appreciate it. Thank you very much for being patient as well. Spencer Boyer of the Albright Stonebridge Group. Thank you very much. All right, taking a look at the markets here. You're having the NASDAQ is still up about 0.6%. The S&P up by 0.1%. Steady as she goes during that press conference. But what did move is the loonie as well as the peso, as you had President Trump discussing tariffs on Canada and Mexico, saying they will go forward, and it's moving along rapidly. Let's get more on this. Jay Jacobs, U.S. head of thematics and active ETFs over at BlackRock. Jay, thank you for being patient. If I wanted to play the geopolitical risk, play the trade war, how do I do that?
Well, I think one of the sectors that has gone relatively unnoticed in geopolitics is technology. This is a sector that has over 60% of its revenue overseas. And yes, it performed very well last year, up about 26%. But if you isolate just focusing on U.S. tech companies, the companies that are buying, selling, hiring, manufacturing in the U.S., really these domestically oriented companies, it outperformed that by about 8% last year. That's what we do in our IETC U.S. focused fund. Really try to isolate the risk of geopolitics on the tech sector in the U.S.
So it's about taking away the risks to the tech sector that does have that growth and also is safety. What other thematic areas can fit that bill?
Well, I think you have to look at something like artificial intelligence, where the U.S. is unequivocally the leader right now. It makes up about 85% of our AI basket in ARTY is U.S.-focused tech companies. Again, this is an area that U.S. leads in. We have the best models. We have some of the best data. We have some of the best data centers around the world, really driving that change from within the United States. But just broadly buying U.S. tech right now and getting some of that unintentional geopolitical risk, I think, is somewhat dangerous for investors.
I am curious, too. I mean, we've seen so much of this rotation into non-U.S. stocks in certain pockets, but we've certainly seen that among some of the big institutions. That's obviously a little bit more of a value play than it is any sort of commentary on Europe versus the U.S. But I do sort of wonder that with valuation so elevated here, are we going to see more folks kind of say, maybe we should look a little bit outside the window into other parts of the world?
We do.
Yeah.
You know, one of the biggest value-oriented themes we see right now is major institutions and wealth managers allocating to infrastructure in the United States. Now, again, this is a very U.S.-focused area because you can only build a road in the U.S. It's not going to cross a lot of borders. But it's more value-oriented companies. These are materials, these are industrials, these are utilities companies, and increasingly investors are allocating specifically 0 to 5% of their portfolio to infrastructure for the growth story as U.S. infrastructure gets reinvested in, for its defensive nature, for its high cash flow, and frankly for some of the diversification it provides to a portfolio.
So then what do you make of, I guess, we'll just call it softness in the market. I mean, and we call it a sell-off, but we're still, probably like a whisper away from an all-time high. Yeah. But you definitely saw that skittishness kind of come to fruition last week. And I am curious as to how investors are kind of balancing the potential risk from tariffs and whatever that ripple effect is into the economy with this idea that there is a meaningful commitment to spending on infrastructure, whether it's traditional infrastructure or whether it's, AI, data center type infrastructure.
It's about investors getting more granular and more dynamic. So if you look at the last 10 years, just buying the S&P 500, IVV, you averaged about 13.5% returns annually. Going forward, BlackRock's capital market assumptions and many other people on the street are looking at about 6% going forward.
Yeah.
So what worked in the past isn't going to get you there going forward necessarily. And we think looking at these more dynamic areas of the market where you see powerful themes powering them, like demographics or artificial intelligence, you can try to capture more of those returns, but you have to get more laser focused.
But this gets to this idea, though, of it being a stock picker's market. And there was a great note out by the folks over at Charles Schwab kind of talking about this idea. We're up 2.5% on the S&P, but on an individual stock basis, there's like an average loss of about 9%.
Right. So individually, the names move really aggressively, but on index level, it doesn't. So how much alpha, then, in that context, you need to have in your portfolio?
I think people need to add more alpha than they've had in the past. I mean, there's a few criteria for alpha, right? You want dispersion between stocks. That gives stock pickers an ability to capture winners and avoid losers. You want more volatility where active managers can really kind of make these plays across the market. And frankly, you need an environment where just beta is not going to get you to your growth targets. So this is really set up as a very strong market for stock pickers for those three reasons. And we see people putting alpha in all parts of their portfolio now. The core, in satellites like actively managed AI, in fixed income where people can rotate amongst areas like emerging market bonds and high yield bonds. We've seen a massive increase in the amount of investors looking for alpha now.
In terms of the safety trade, irrespective of infrastructure, irrespective if you just want to get some nice calm beta, where is that in the market?
I don't know if it exists in the market right now. I mean, you see volatility, these bouts of volatility across the market. I think it's about being choosy about where you're trying to get growth and frankly adding more diversifiers to a portfolio, whether that's gold, whether that's something like Bitcoin even, whether that's something like infrastructure. People are looking far and wide for things that are not just going to behave like the S&P 500.
All right, great stuff. Always a great conversation. Jay Jacobs, U.S. head of thematics and active ETFs over at BlackRock. A closer look at some of those rotations that we've been seeing in this market. And that includes some of those big tech names that he was talking about. And that also includes Microsoft. We want to take a look at one of the big analyst calls out there today in our top calls, and it comes from TD Cowen. The note's generating a lot of buzz. The analyst there is saying that Microsoft is scaling back on some leases for AI data center capacity. And that is, of course, leading some people to question if Microsoft maybe bit off a little bit more than it can chew. And are there going to be ripple effects for some of the other companies out there? Michael Elias joins us right now. He's a senior equity analyst over at TD Cowen and the man behind that note. And Mike, of course, this is the note everybody is reading this morning. And I am curious about this. I mean, is it just kind of Microsoft just kind of trimming a little bit around the edges? I mean, after all, its commitment, or at least its monetary commitment to investing in this space is still relatively large, even if you back out these data centers that you yourself are writing about.
Yeah, I think that's a fair point. They've clearly made a big commitment. If we look over the course of the past 2 years, since we really saw the boom in the AI demand wave for data centers, we've seen Microsoft be the most actively served data center capacity across the hyperscalers. With that, I think this is a bit of pruning around the edges. But what I would say is, we were highlighting in January a broader pullback from Microsoft from the market. And I think as we contextualize it, one of the big shifts we've seen out of Microsoft is it seems like there's been a change in the relationship with OpenAI. And we're seeing incremental workloads going over to Oracle. I mean, we saw the Stargate announcement. That's been making news in the industry. So really, we think that it's just a mix shift between Microsoft and Oracle related to OpenAI, rather than a wholesale change in aggregate AI spending. I want that to be clear to the viewers. We're still seeing very strong investments in data center, very strong data center demand, with data center demand up year over year following record levels of leasing in 2024. So broader demand remains intact, but we are seeing a shift out of Microsoft, and we do view it as idiosyncratic.
Well, okay, so idiosyncratic. So for investors then, the main concern, and I'm sure you know this, Mike, was this idea of whether there was an overspend in this space, whether people were sort of entering these leases, taking on data centers, taking on energy contracts for that matter, that really weren't actually going to provide any sort of immediate ROI, given the end use case for a lot of this technology, at least in terms of financials, hadn't really materialized.
Yeah, so what we're seeing is, we still continue to see the investment being made, and a lot of the investment that's being made continues to be made in training, which, as I'm sure you know, is the precursor to inference, which will ultimately be the revenue generation engine for the hyperscalers and how they'll make their ROI on the investments in AI. But we continue to see active spend from all of the hyperscalers, from Microsoft specifically. It's interesting if you follow some of the podcasts recently that the CEO has been on. Yeah, I find it interesting that makes incremental references to revenue and inference. We've built capacity. Now the customers need to come. So we think that they've pivoted. They were first in the market. I think they're pivoting a bit, and now they're focused more on the inference side of things. And as a result, if you need less training capacity incrementally, that would come as a headwind to incremental data center demand. But nonetheless, they're still active in the market. And again, they were the most active leaser of capacity. So it stands to reason that they might be first to the shift onto the inference side.
So, Mike, from what you're saying, though, this should be a positive thing for Microsoft. So if they're leaving Oracle and OpenAI to the training part, which is a less of a revenue generator, and focusing more on the inference, that should be a good thing. So I was really puzzled as to why the stock gets hit.
I'll leave it to the Microsoft analysts to speak to that. But as I think of the broader supply chain, I want this to be clear to the viewers, is that we continue to see very strong demand for data centers. And obviously, the chips, the servers, the memory, the networking gear that goes into the data center, to the extent we see very strong data center demand, that should read through positively to the rest of the supply chain. However, I appreciate in this market dynamic, it may be a little bit more nuanced than just, hey, they're pulling back on data center on their data center demand. Let's look at the implications for free cash flow, just given there is a big market opportunity out there associated with inference.
Yeah, no, fair enough. Mike, so to that point, do we expect sort of moving in and out of these leases, or even like the statements to leases? Is this going to become typical for these hyperscalers as they digest the correct demand?
I wouldn't say that. I would say that historically, the hyperscalers have built their own capacity as the baseline for which they fulfill their incremental requirements. And then from there, anything in excess, they'll go out to the market and lease. They have historically been disciplined in the way that they have gone about leasing. We rarely see situations like this. And just to be clear, as we were flagging in our note, the instances where we are seeing some trimming around the edges, it's because of delays on the power side or facility level delays tied to supply chain. So from our perspective, we don't view this as a wholesale shift. And to the extent that you have a delay, let's say, of power related to a facility, you don't have a data center, you have a glorified industrial building. So to that end, we're seeing pruning along those lines, but we don't expect to see additional pruning from the other hyperscalers.
Really great analysis. Thank you so much. It was fun to get you on, Mike. Thank you very much. Mike Elias joining us over at TD Cowen. One other stock that we're keeping our eye on is Palantir. That stock is getting hit hard, the worst performer in the S&P amid news the Defense Secretary Pete Hegseth plans to reduce U.S. military spending. That's a move that could greatly impact Palantir, that had more than 40% of their revenue in the 2024 form government-related business. Joining us now is Louie DiPalma, analyst at William Blair Co. All right, Louie, what kind of revenue, what kind of earnings are at risk now for Palantir?
Thanks for having me on the show. So specifically, 42% of Palantir's revenue comes from the U.S. government. So that's their exposure. But in terms of the risk, we would project that Palantir's revenue is very sticky. Their software is via a subscription model, and they've demonstrated very high resiliency. So in terms of revenue at risk, it's not really about their current base of revenue, because we don't forecast any Palantir contracts being terminated in the near term. But there is risk that future projects could be pushed to the right.
Yeah.
For instance, Palantir is competing with L3 Harris for a program called next generation command and control, and there's supposed to be a contract award in the spring or summer, that could be pushed to the right if on March 15th, if there's a government shutdown, for instance, or another extended continuing resolution.
I am curious, though, Louie, and because a lot of people have talked about this, and I think prior to the Trump administration, I think a lot of people thought that this was a net negative for the company. There are some people that look at this and they say, well, Alex Karp's relationship with some of the cabinet members, including Pete Hegseth, might actually be a bit of a ballast. So are we just basically just talking about revenue or contracts deferred rather than actually lost?
Yeah, it's all about a question of timing. In the near term, there could be contracts deferred. But in the 2026-2027 timeframe, if you want to look into potential bearish scenarios, you would look at how Palantir has and reported a 45% operating margin, which is one of the highest for all of the defense industry. If you were to look at traditional defense platforms, they have margins in the mid-teens. And, we've seen an instance of the FDA, switch off of Palantir, citing, very high total cost of ownership. And the FDA decided to build its own in-house data analytics platform called Cedar One Analytics. Yeah. And so, it's a buy versus build decision, and they thought it'd be more economical to build their own data platform. If the government wanted to be more efficient, they could offer more competitions for some of Palantir's existing.
Yeah, I got you. I certainly understand that risk. So just kind of bringing it back for investors who are trying to assess whether this high valuation is actually high or maybe there is something left in the tank here. There has also been this idea that the company had been trying to broaden out away from just its dependence on government contracts, more corporate contracts. And we saw that show up in the last earnings statement. They clearly are seeing growth there. Is that growth going to be fast enough to offset any potential loss or deferment of government revenue and contracts?
Yeah, it's related to how, in terms of street expectations and the company guidance, investors expect both divisions of the company to be firing on all cylinders as the company is priced to perfection or more than perfection. So, even if the U.S. commercial division remains stellar, if there were to be a deceleration in the U.S. government division, that would penalize the stock.
Well, then to that point, Louie, do you think it's adequately priced, seeing sort of the most dramatic fall ever for this stock today?
So, you can make the case that, the stock perhaps shouldn't have run up as much as it has. And you can make the case that, this current, downward stock move, isn't the most rational either. But this is a momentum name. And in terms of, where the floor could be, for Palantir, there's no valuation baseline here. You would consider its closest comps to be, Snowflake, which is at a $60 billion valuation, and privately held Databricks, which is also in the $60 billion ballpark. So Palantir is around $220 billion, and that's why you see the volatility.
All right, Louie, got to leave it there. Really appreciate you taking time for us. Louie DiPalma, an analyst over at William Blair. Palantir shares down more than 11% here in the cash session. Biggest decliner on a percentage basis in the S&P Financial, in the S&P 500 index, Alex Steele, as we count down to those closing bells with just about 8 minutes to go. And there's not a lot of help from the other tech stocks either. NVIDIA down, Broadcom down, Meta, Amazon, Microsoft. Yep,
you got financials up, healthcare up, but nothing that exciting. And we're definitely rolling over a touch. Like, we're clearly off the lows of the session, but seeing a little bit of steam to the downside in these last 10 minutes.
I thought the narrative was all the dip buyers were here.
Yes. Are they, though?
I don't know. Well, it was kind of interesting to see the price action this morning because you actually had some of the indices open lower. Some dip buyers did sort of come in, and that push, I think the S&P was up like 1% or something at one point on the day, now back in the red. So it kind of raises the question as to where the conviction is behind these trades.
Yeah, and Scott Rebner over Goldman Sachs, right, that no doubt, he said, look, I think the dip buying is coming to an end and definitely starting in March, and he's kind of warning of a correction. So are we on the last legs of this dip buying?
Kara Murphy joins us right now, Chief Investment Officer at Kestra Investment Mgmt, to help us count you down to these closing bells. And Kara, I do kind of want to pose that to you here. I mean, it's very clear investors are looking for opportunities. But when you look at the price action, at least for today, it's clear that maybe people aren't quite finding it.
So I would characterize today's market as a little bit different than simply like dip buying or not dip buying. In my perspective, it's encouraging to see a day where you can have the S&P 500 relatively flat and some of the most favored names like the Mag 7 underperform. So I think this is a sign that investors are maybe a little, wearied with the Mag 7 story and looking for other opportunities in the market, and they're finding them. And so we are able to see a market that does okay, even if some of the darlings are underperforming.
I am curious as to where you are finding those opportunities. I mean, are there specific sort of pockets that you find attractive right now?
Right now, it's fairly easy once you get outside of some of the largest names in the S&P 500. And I think one of our favorite areas is just to simply go down cap a little bit in the S&P 500. So you don't even have to go all the way to something like small cap. You can go to smaller, large cap or mid cap. And in those areas, what you find is stocks with accelerating earnings as we head into the back half of the year, much more attractive relative valuations, and some really good fundamental stories that are sometimes, pretty well insulated from things like higher rates and tariffs and that sort of thing. So I think there are a lot of potential areas.
Well, would you categorize the earnings season as good or bad? Like, clearly you can make an argument that, look, earnings growth is actually better than we thought, but Bloomberg Intelligence says that if you outperformed the S&P on earnings, you did so by the least amount since 2020. How do I take those two things?
I would say this earnings season so far has been fine.
Fine. I hate the word fine.
But this comes on the heels of several earnings seasons that were really good. So I think coming off of that, the momentum definitely feels like it's slowing a bit, even though you have like the number of names that are outperforming expectations, that sort of thing, are in line with historical averages. They're not the really great beats that we saw recently. And as you said, the market reaction to those is not quite as positive as what it has been. And I think, again, this presages a shift in earnings in the back half of the year where some of the really strong earnings growers are going to see slower growth, and then some other areas of the market are going to start to see a pickup.
Kara, what kind of market action move do you think NVIDIA is going to be this week? How closely are you going to be monitoring?
Well, it's a really important part of the market, so we're always going to follow it, but we don't necessarily predict what it's going to do from one day to the next. So there'll be a lot of eyes on that earnings report in a couple of days.
Kara, I do have to ask you, though, a little bit here, a longer term, too, because there's clearly some concerns in this market about geopolitics and just kind of the shifts, right? I mean, we are going through change right now globally. And obviously that tends to knock a lot of people off guard as they try to assess what that's going to mean for their particular portfolios and their particular lives here. What is, I should say, the primary risk that investors should keep an eye on for the next, 8 or 9 months?
No, I think it's a great question, and it is one that is really important. And I think the general theme is going to be heightened policy and geopolitical risk going forward. You have an administration who is now in power who has been very open about the idea that they're willing to break things. And you might agree with their agenda or not, but they're willing to move very quickly and introduce a fair amount of uncertainty. And I think we need to acknowledge that. And if you look at some measures of, like mentions of global policy uncertainty, those are higher. Other measures of global geopolitical risk are higher. So I think these are things that we have to really keep in mind. And we need to sort of have that additional sort of cushion as we move forward.
Yeah.
Now, as I think about the biggest policy risks as a U.S. investor, the biggest one, I think, for me, is government spending. And you have a lot of focus on trying to draw down government spending. But if you look back, starting with Truman, every president since then has actually increased government borrowing. So I like to describe government borrowing and overspending as an American problem, not a party problem.
Yeah.
And that also means that it's very, very difficult to roll back. But as interest rates stay higher, that's only going to become a harder problem to tackle.
All right, Kara, I have to leave it there. Always a great conversation. Kara Murphy, Chief Investment Officer ever at Kestra, counting us down to those closing bells. Alex, we are just about 2.5 minutes away. Stocks right now, at least the aggregate indices, right now near those session lows here, 1% lower on the NASDAQ, about 0.5% lower in the S&P. These were higher in the green earlier in the day.
Yeah, we are definitely gapping lower into the close. That's for sure. That feels like it's never a good sign. So those, I wonder how extended that can be for tomorrow morning session.
It's kind of interesting, too. The VIX remains elevated, and, of course, a lot of activity in the currency market as the president doubles down on that commitment to start those tariffs on Mexico and Canada. A full breakdown of all of today's price action, that starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you to that closing bell. A global simulcast. It starts now. Scarlet Fu in the TV studio, Carol Massar and Tim Stenovic in the radio booth. All five of us back together as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube here on Carol.
Yeah.
That was supposed to be a buy the dip day. What'd you do?
Yeah, I don't know. I guess they got the memo, they didn't get the memo, and you are seeing some selling here into the close. So we may finish near or at our lows of the session. Having said that, you go into the S&P 500 kind of half are up and half are down, even a little bit more to the upside than to the downside.
Carol, have you seen your NASDAQ Golden Dragon China Index today?
I didn't. I know, not so great.
I saw it.
Down 5.2%. There's this memo from the Trump administration to curb Chinese investment in U.S. tech, energy, and strategic sectors. That's sort of this chill across many of the companies based in China.
It's had quite a bounce, though.
Yeah, well, leading with Alibaba, right? That stock is down 10% as we head towards the close.
Would be a really good decliner.
The S&P 500, the 50-day moving average, and the 6,000 level are the ones that you need to be watching for. Now that we seem to have broken below that, it really comes down to the 100-day moving average. And I bring this all up because there's still so much uncertainty, so you end up looking at things like technicals.
Well, what's also so interesting, too, is this is the 36th session that we haven't had 1% consecutive declines, right? But we're now having 0.5%. Does that kind of count towards something? Does that inch us towards something else?
I don't know. I think to a certain extent, I think you're right. Although I think Carol makes a good point too. Is you're still looking at the majority of the stocks in the S&P higher, and this kind of gets to what I think Kara, as well as Jay Jacobs, some of our earlier guests on Bloomberg TV, were saying is that there is still a lot of buying. It's just not in those names with the largest weightings that are able to sort of move this market. And that's a big part of the reason why you're looking at a lot of red on your screen. The S&P 500, which opened higher and then spent a considerable amount of time in the red and then a considerable amount of time in the green. It's going to close out the day lower by almost 30 points or about 0.5%. The NASDAQ composite is down more than 200 points or about 1.2%. Similar declines for the NASDAQ 100. The Dow, that's your bright spot here, but only higher by about 1/10 of a percentage point. And if you take a look at the small caps, the Russell 2000 looks like it's going to finish the day lower by 17 points or 0.8%.
All right, I'm kind of flying high since Romaine called me out in a good way, so I'm just going to go back there. S&P 500, 284 names to the upside, and you got 219, Scarlett, to the downside.
We all live for those shout-outs from Romaine.
We do.
Let's take a look at the IMAP here. You've got 11 sectors, and 5 of them are in the green, 6 of them are in the red, so pretty evenly split. Your worst performers are tech-related, so infotech, consumer discretionary, and communication services. The best performers tend to be some of those more defensive sectors: healthcare, real estate investment trusts, and financials.
And Nike sneakers. They are one of my gainers in today's session. They're up 5% here, so just finishing off their highs. Jefferies upgrading the stock to buy from hold, saying the company is being positioned for a strong recovery over the next couple of years. The analyst there saying it was his new top pick, lifting the stock price target to 115 from 75, so quite some upside from here. And this was your number 2 gainer in the S&P 500. Berkshire Hathaway, guys, a gainer as well, up 4% on heavier volume today. Company reported over the weekend that operating earnings surged 71% in the fourth quarter, driven by higher interest rates and a strong recovery in its insurance underwriting business. And then you have Bridge Investment Group up about 34%. Apollo Global Management buying the company.
I just want to say the Berkshire thing. I was so amused by how people were characterizing that cash hoard that they have, which is now over $300 billion. And some people are saying, "Oh, that's a great thing." Other people saying Buffett's out of ideas. I don't know.
Haven't we been saying that for years? The whole too much cash, out of ideas, nothing to buy.
There, right?
Yeah.
Yeah.
It'd be nice to have that kind of cash.
Or maybe he thinks things are overvalued.
Think of that
Who
high-yield
knows?
savings account that would
know.
happen.
Yeah.
Would you rather him spend it on a bad idea? Probably not.
No, I just like some of that cash.
Yeah, me too. Yeah. Spread it around, Warren.
Yeah.
Let's.
Does Tim have something to say? Oh, sorry.
He's paying taxes. That's what he's doing with all that money,
Tim says
right?
all he needs is $10 million. Isn't that what you said?
Yeah, that's it. It's not a big ask. Look at shares of Palantir today, down yet again, 10.5% decline today. It's the biggest 4-day drop going back to 2020. 2022. This all follows news last week that Defense Secretary Pete Hegseth has projected U.S. military spending to be cut by 8% over the next 5 years. It potentially jeopardizes this key source of revenue for Palantir. It is down 27% from that all-time high back on February 18th, so just last week. According to Bloomberg Intelligence, more than 40% of Palantir's revenue in 2024 was U.S. government related. Certainly one to keep an eye on, as it's lost more than a quarter of its value in just 4 trading sessions. And we did see shares in power and electrical equipment companies fall today. Constellation Energy, among the biggest decliners on a percentage basis after Palantir in the S&P 500 today, down about 6%. This after TD Cowen noted that Microsoft had begun canceling leases for a substantial amount of data center capacity in the U.S. This coming from TD Cowen. We should note that Microsoft has voided leases in the U.S. totaling, quote, a couple of hundred megawatts of capacity. It's the equivalent of roughly 2 data centers. TD Cowen wrote in a note on Friday citing channel checks or inquiries with supply chain providers. And then Scarlett giving a little bit of preview for my final decliner, Alibaba ADR is falling by 10.2% today. Biggest fall going back to October of 2022. President Trump's latest executive order deepened investor concern over the economic showdown between the U.S. and China. It has to do with CFIUS. Trump directed CFIUS to limit Chinese spending on tech and other strategic U.S. sectors.
All right, guys, I'm taking a look at the bond market. You saw buying pretty much across the curve. The 2-year yield was down by about 2 to 3 basis points. And I say that because we had a 2-year auction that basically you saw mostly indirect bidders show up. Domestic demand really feel like they just did not show up. Tomorrow we get $70 billion in 5-year, and then you get $44 billion in 7-year. So more to come on the bond front.
All right, guys, we've got a New York City focus here for some of the stories that have caught our attention. This one has to do with billionaire Ken Griffin. You know him well, right? We talk about him. He's moved his company down to Florida, but he's actually been adding to his New York real estate holdings, in this one in an iconic building that used to be home to Vera Wang or Jackie Onassis. We're talking about 740 Park.
Yeah, you might have heard that Julia Koch, the widow of the billionaire industrialist David Koch, sold a unit at the building for $45 million. The guy behind it, Ken Griffin, that's according to people familiar with the situation cited by the Wall Street Journal. The Kochs paid about $17 million for this pre-war unit back in 2004. Property records.
This got my attention because it's not in Florida. It's not in Palm Beach.
I know.
No.
I noticed that.
No.
He's got a huge presence here in New York City.
Likes real estate here, yeah.
We are getting some earnings. Sorry to break it up here, but we are getting some earnings. It's out of Hims and Hers. Of course, this is the telehealth company. It looks like a beat on some of the key metrics here, with orders in the most recent quarter up to about 2.8 million. Actually, the street was looking for about 2.9 million, but revenue did come in higher than street estimates at 481 million versus street estimates of 475. And here's your forecast, with the company saying that it sees full year revenue in the range of 2.3 to 2.4 billion. The lower end of that range is well above the average of street estimates for roughly about 2.1 billion. Of course, remember, there was a lot of concerns about whether this company would be hurt by some of the changes over at the FDA regarding the shortage designation for those GLP-1 drugs, which of course have been a boon to this company going forward. The shares, though, down about 8% here in the after-hours trade. Also
taking a look here at Chegg. It is an online educational platform, right? And it looks like they actually did beat earnings estimates. In the press release, though, they say they're launching a strategic review process, plus they filed a complaint against Google, which has unjustly retained traffic that has historically come to Chegg, impacting their revenue, employees, and acquisitions. So that's an interesting development there. That's pretty much flat.
All right, guys, let's get to Zoom Communications, which is flat here in 2025, but we're seeing some movement in the aftermarket, seeing it down about 1.4%. The company talking about first quarter revenues. Let's go to the outlook. Sees first quarter revenue $1.16 billion to $1.17 billion. That could be a little light. The street is $1.17 billion. Sees 2026 operating income of $1.85 billion to $1.86 billion. Again, the street estimate's about pretty much there, $1.85 billion. And just going back to the fourth quarter revenue, $1.18 billion. That's spot on. And fourth quarter adjusted EPS, $1.41, and that's 10 cents better than what the street was expecting. But again, we're seeing maybe some disappointment, some concern potentially about the outlook there. Stock just down about 1.4% after market.
All right, just want to go back to Hims for a moment. We saw the stock moving down in after-hours trading, and one reason could be because gross margin was 77% in the quarter. Analysts were looking somewhere north of 78%. So the stock currently extending its losses down to 11% right now. Also, you have net orders coming in below analyst estimates, 2.81 million. Analysts were looking for 2.9 million.
All right, Scarlett, Hims and Hers down about 12% here in the aftermarket, so taking quite a beating. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. Alex, I know you're heading out. Scarlett's hanging around with Romaine. Continue on television. Tim and I continue on Business Week right here on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
Our coverage continues here on Bloomberg Television. A breakdown of some of those big earnings that we just got, including Hims and Hers, biggest decliner right now in the after-hour session. We're going to check in on the telehealth company, and we're also going to check in on another healthcare company, Oura Health. The CEO, Tom Hale, he'll be on the program as well. Stick around. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. It looked like it was going to be one of those days where we saw the dip buyers come in and boost this market, but that dip buying faded in a big way as we got closer to those closing bells. An S&P 500 that was up about 1% on the day, closed out the day down by about 0.5%. And a big part of the reason is that second line of your screen. No real help from the Mag 7, no real help from big tech overall, which is now down for a third straight day here. And so without the help from some of those big cap names here, it's hard to really get the overall index moving. Financials were lower on the day, as were a lot of the ADRs of those Chinese companies, which, of course, have been on a phenomenal run. Of course, maybe a little bloom coming off the rose after President Trump signed an executive order over the weekend that appears to target some of the investments in Chinese companies.
Yeah, with Alibaba down about 10% in today's trade. All right, here's another tech name that has become a big tech name just because of the magnitude of its gains in the last 2 years. Palantir, today falling for a fourth straight day, down about 10.5%. The defense secretary said he plans to cut projected U.S. military spending by 8% over the next 5 years. The U.S. government makes up about 40% of Palantir's revenue. Berkshire climbing to a record high. Its operating earnings jumped 71% in the fourth quarter. That's thanks to an increase in insurance underwriting.
All right, I just want to put one other mover out there. This is in the after-hours trade, and it is Chegg. This is the online education company, down 22%. They reported earnings, but they also said they have launched a strategic review of operations and that they have retained Goldman Sachs in connection with that strategic review. Of course, this is a stock that has been absolutely pummeled over the last few months, now trading at roughly about $1 a share here in the after-hours trade. Now, the main headline here, not having anything to do with the earnings, really about more of their future going forward. We're also keeping an eye on shares of Hims and Hers, which were prior to Chegg, the biggest decliner in the after-hours trade. Those shares still down by about 14% after they reported earnings that missed for the fourth quarter, but they did give revenue guidance for the full year that was above street estimates. John Tozzi joining us right now, who covers the healthcare sector for us here at Bloomberg. And John, what was your initial read on this earnings report? Because there's so many things swirling around this company that really go beyond just those top and bottom line numbers. Why do you think we're seeing this type of reaction?
Yeah, I mean, I think we're still trying to figure this out and obviously getting results here in real time. I think, one thing to know about Hims is there's been a huge run up in this stock over the last year, a little longer, since this company got into the business of selling weight loss drugs. That business is now uncertain because Hims sells sort of compounded versions of these drugs that are only permitted to be sold basically while the brand name drugs are in shortage, and those shortages are ending. So I think there's a big question mark for investors over what happens next and where the company goes from here.
Do we have a sense, John, of how much it relied on revenue from these compounded versions of these weight loss drugs?
Yeah, I mean, offhand, I don't have that in front of me, but I think, it's certainly been a big piece of the business and important driver of, again, we've seen the stock just on, real increase throughout 2024 after the company got into into this business.
This raises a lot of questions, though, just about the overall business model, not just for Hims, but also some of its competitors. And this idea that, I mean, for lack of a better phrase, kind of took advantage of some loopholes that were out there, those sort of gaps in regulation to sort of build this business even before GLP-1 drugs came out. And I am curious, John, as the sustainability of that business, particularly in light of the new administration and the new regulatory approach that they might be applying.
Yeah, I mean, I think investors have the same questions, right? And I think, some of the analyst commentary before these results was, looking at, asking the company for like a clear legal pathway for, this business, given the end of the shortages for the GLP-1s. I think we've heard from the company that they intend to continue selling with different, perhaps different dosages, different formulations that might be mixed with, vitamins or other, other ways to continue selling these products to the customers. There's no question the demand is there. I think the real question is, what is the regulatory framework? And does that change under the Trump administration? I think that's still all to be figured out.
All right, John Tozzi, thank you so much covering the healthcare sector for us as we look at Hims shares tumble in after-hours trading. We also have earnings coming out of Topgolf Callaway, or I should say losses, because the fourth quarter adjusted loss per share was 33 cents. That was narrower than the analyst estimate of 42 cents a share. Revenue for the quarter was $924.4 million, higher than what was anticipated, and EBITDA of $101.4 million, also topping analyst estimates. Nevertheless, the stock down by about 5% right now. All right, we want to go back to health and wellness for a moment and turn to Oura Health. The company is on a mission to help wearers of their smart ring live healthier and longer lives by providing personalized health data. And in fact, the company's latest funding round has Oura valued at $5.2 billion. We're pleased to say joining us right now is the CEO of Oura Health, Tom Hale. Tom, great to have you on Bloomberg Television. I want to start with connecting the dot between the weight loss drugs, the GLP-1 drugs, and what you provide to your users. Have you seen the popularity of those obesity drugs? I'm curious what kind of impact or spillover it has to the market that you are serving.
Yeah, so we started in sleep, and for everyone's information, we make a wearable ring that tracks your biometrics and gives you insights and data. And of course, one of the things that our customers are extremely interested in is metabolic health. One of the things that we did last year was start to enable people to track their meals by taking a photograph and seeing the results of what they had eaten, and then start to map that to their metabolic impact. We signed a partnership with Dexcom and also received investment from Dexcom. And Dexcom is the maker of continuous glucose monitors, which is a way you understand your metabolic health through data. So in Oura, what we see now is that people who are generally trying to monitor and manage their health and improve their and optimize their health are really focused on their metabolic health. And GLP-1s basically affect your metabolic health. Now, here's a little known fact. Metabolic health and GLP-1s, they act on your body in a way very similar to sleep. So the more sleep you get, the better off you are. It helps reduce your appetite. Midnight snacking is a real thing. If you don't sleep, you want to eat. And it also helps you feel more satisfied. So one of the things we do is we help people understand the impacts of their behaviors on all sorts of their health, including metabolic.
Got it. Thank you for explaining that. So the ring itself can cost about $300, and then there's a membership fee as well, a monthly fee of about $6 a month. Do consumers have subscription fatigue? And I ask that because your monthly fee is pretty low relative to, a lot of other subscriptions out there, and I'm just wondering how you arrived at that.
Yeah, it's interesting. I think people do have subscription fatigue, particularly for things that don't provide value. Of course, your health is priceless. And so for people who get the value out of managing and monitoring their health, actually, they're willing to pay quite a lot more than the modest subscription fee that we charge. The thing that I find most interesting as somebody who's been in subscription businesses for most of my life is that the retention rates for Oura are literally off the charts. We are better than best in class than consumer subscription products like Netflix or Spotify. It's really stunning. And I think that just goes to the fact that if you've invested in a piece of hardware, which people do, they buy the ring first before they pay the subscription, and you care about your health, you will retain really, really well. And so our subscription business is both large and very, very stable. So we're very pleased with the outcome.
I am curious, Tom. where's the competition? When this ring first started to become popular, there was this idea that, you were going to be knocked off in a big way. And I know there have been a few entrants in this space that have kind of come and gone or certainly didn't get traction. Well, I mean, what are you doing that I guess these other companies can, and particularly the larger companies, the Apples and Samsungs of the world?
Yeah, I think the most important thing is that we've been doing this for a long time. As you probably know, the power of AI and machine learning really depends on data. And we've been collecting not just data from our users, but scientific research data to really inform our algorithms and inform our product. We're a science-first company. Mm-hmm. We depend always on the research and always on the differentiation that science can provide. The other thing that's really important to recognize is that as people come to this market, many of them come to it thinking about the problem that they're solving is fitness. This is sort of a classic use case for wearables, so the Fitbit, that's how people think about it. Whereas I think our approach has been to think much more broadly about health. So for example, we started in sleep, we expanded into women's health. Now we're looking at cardiovascular health and metabolic health as we started this conversation. And the breadth of that offering, people don't necessarily just want to think about one dimension of their health, they want to think about all of them.
So what's next for this company? We talk about a company that's more than 10 years old right now. It's had phenomenal growth, phenomenal revenue. And obviously, Tom, your appointment a few years ago as CEO raised a lot of speculation that they would be ready to go public. That was 2022. It's 2025. Are you going public this year?
I don't think we have any plans to go public. And quite frankly, as someone who's operated public companies my entire life, I'm really enjoying operating a private company. Yeah. And so I don't think we've got a lot of ambition to go public anytime soon. And if we do, we will definitely let you guys know.
Yes, let's make sure that happens. Tom, final question to you. What is your fastest growing customer? Is it, the young people, or is it someone who is on a new fitness kick because of something like GLP-1? Are they seniors?
Well, this is stunning. So we have customers across the entire spectrum, from CEOs to moms to busy dads to teenagers and college kids who are managing their health. The interesting thing to me is that two big changes in our demographic in the last 12 months have been, one, women. We actually used to be majority men, and we've slipped to majority women. And that's on the back of our FDA-approved features like fertile window or just basically the ability to predict when you're going to have your cycle, which, by the way, the ring can do very accurately because it's using temperature to predict it. The other side of it, of course, is young people have been really, really into health and really into being proactive about their health. And we've seen that group, basically, kids and young adults from 18 to 25 is the fastest growing demographic and is about a couple percentage points from being the largest demographic for Oura. Really interesting to see how important health is to the youth and the young people around the world.
All right, Tom, appreciate you taking time for us. Tom Hale, CEO of privately held Oura Health for now. All right, I should just full disclosure, I'm a customer of these rings and have been for the last, at least 2.5 years, 3 years or so here. It's great. I do have a beef with them though. They need to make the chargers kind of compatible with everything. So
wait, it's a different
well, because it's sized to the individual ring. So if you have two people in your household, they have two different rings, you can't use the same charger, it's the whole thing, blah, blah, blah.
Yeah, it's a lot more plugs than you want to deal with, right?
Yeah. That's just, this is the time of the show where Romain just airs out his personal beefs.
I love it. Let's throw in airline lounges too, and then we can just make it a complete, airing of the grievances. Yeah. All right, coming up, we've got the top three, where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Anne Wojcicki, the co-founder of 23andMe, refreshing her take-private offer for the genetic testing company, this time with backing from New Mountain Capital. She's been trying to take this company private since last year. So this has been kind of a long journey.
Yeah, I've been very fascinated by this. I mean, you think about the heights that 23andMe got to and how it was just really in the zeitgeist, came to public markets and then just kind of dwindled. You do wonder if maybe there is a life as a private company, a second life for this as a private company, without that sort of scrutiny of that sort of quarter to quarter, Wall Street sort of, pressure mill. We were asking Tom Hale at Oura about that, and he basically said, look, they're happy being a private company.
Yeah, they're happy. But, that's the other thing. Like, once you've gotten the testing kit, do you need to get another one? You're done. as a customer, you don't need to go back.
All right, I'm keeping an eye on Lester Holt. Of course, this hits close to home. He was a longtime anchor of NBC Nightly News. We're learning that he is stepping down from the daily news show later this year, though he will stay on at NBC on his Dateline, that other news magazine show, to do that. And, I'm a big fan of his. He is, started his career in Chicago, and I have very fond memories of him. And when I was in college, I used to work at a record store, Tower Records. That's how old I am. And he would come in. He was a local anchor, and he would come in. Their studios weren't far away at the time. He was, I think, of a CBS affiliate, and he would come in, and he was always so nice and friendly, and he would just talk to some dumb college kid, asking him a bunch of dumb questions about God knows what. He's a big jazz fan, by the way.
Oh, interesting. Yeah. I love hearing personal details about guys like this.
Yeah.
I mean, they don't know who's going to replace him, but I wonder if it's even going to be a person. It'll probably be a rotating cast, kind of like what they're doing at CBS.
Yeah, obviously a lot of moves being made across the media landscape, and we have to end on a somewhat sad note here. Roberta Flack has passed away. She was a Grammy-winning singer and pianist. She passed away after battling ALS and Lou Gehrig's disease. I wish to point out, the number of hits that she's had. First Time I Ever Saw Your Face, obviously Killing Me Softly, which of course got remade by Lauryn Hill some years later. Just an absolute icon.
Absolutely. You know what I didn't realize? I just learned she was a prodigy pianist as a child.
She was incredible, and the amount of songwriting credits and composition credits she had would blow your mind. Way more than just a singer. She started out as a teacher, Scarlett Fu.
Pretty amazing.
All right, let's take a quick look back at this day in history. Back in 1982, when the first stock index futures began trading, and of all places, Kansas City. The Kansas City Board of Trade in the 1980s was the primary exchange for trading futures in soft commodities, like the winter wheat used in bread. But the company was seeking to expand its offerings and decided that there was appetite for futures contracts based off equities. So it took the value line composite index of about 1,600 stocks and created a contract system to bet on the future price level of that index. It was revolutionary at the time and would have sparked a massive transformation of future markets, which at the time were predominantly centered around agriculture contracts rather than financial products like stocks. That transformation began to take shape a few years earlier when what is now the CME Group helped facilitate the adoption of currency futures following the collapse of the Bretton Woods Agreement in 1971. Shortly after that, the Chicago Mercantile Exchange and the Chicago Board of Trade introduced futures on interest rate products such as Treasury bonds. The stock index futures, they debuted on that morning of February 24th, 1982, to a larger than normal crowd of traders gathering on the floor of the exchange with Kansas City Mayor Richard Berkeley ringing the opening bell. 500 contracts traded within the first hour, and by the end of the day, about 2,000 had swapped hands. Now, unfortunately, while the idea of stock futures was sound, the decision to peg it to the value line index proved to be a major misstep, as most institutional investment products were benchmarked to the S&P 500. So eventually, the value line contracts would disappear, and the Kansas City Board of Trade would eventually be bought out by CME. But its legacy does live on. More than 2 million stock index contracts trade each session, a far cry from the 2,000 on that first day back in 1982. And financial futures overall, which include stocks, equities, and currencies, they've grown from about 20% of all futures markets in the 1980s to around 85% today. Scarlett?
Yeah, so financialization of our daily lives in play right there. All right, let's move on to politics because President Trump and France's Emmanuel Macron met at the White House today to discuss U.S.-France relations as well as peace talks to end Russia's war in Ukraine. During the joint news conference, President Trump was asked about his plans to implement tariffs. Take a listen.
The tariffs are going forward on time, on schedule. This is an abuse that took place for many, many years. And I'm not even blaming the other countries that did this. I blame our leadership for allowing it to happen. I mean, who can blame them if they made these great deals with the United States, took advantage of the United States?
For more on this, let's bring in Bloomberg Balance of Power co-host Kailey Leinz. So, Kailey, just remind us again of which tariffs we're talking about here. The 25% levy on Canada and Mexico, that's set to go ahead, even though last time around they delayed it by a month because there were still some deals being struck.
Yeah, and that delay, Scarlett, is about to expire. March 4th is how much time the president gave these two countries to address his concerns when it comes to the border and the flow of people and illegal drugs over them. And his suggestion at the press conference today was he still does intend to implement those 25% tariffs come next Tuesday, though he later then went into his plans to implement other tariffs, including reciprocal tariffs, which would apply to countries like Mexico and Canada, but many others as well that they intend to move forward with in April. He's threatened car tariffs to go into place on April 2nd as well, because he doesn't like the idea of doing April 1st, which would be April Fool's Day. But we have seen time and again that these tariff threats are made and then not actually acted upon at the date that the president initially put forward, as happened initially with these what were supposed to be February 4th implementations of these tariffs on Mexico and Canada. We've seen this with Colombia as well. So until this actually is signed and implemented, it is not something that is necessarily guaranteed to happen, as we have seen this president using the threat of tariffs really is a negotiating tactic to extract concessions he wants from other countries, though he also has suggested he wants to see tariffs help the United States raise revenue as his tax cuts are pursued in Congress. So there are a lot of different components here. There's also the memorandum he signed last week that would take a look at implementing tariffs as retaliation for digital services taxes European companies charge tech companies, U.S. tech companies specifically. And that's actually something that came up in this news conference with French President Macron.
I thought that was an interesting question, and more importantly, a more interesting response, Kailey. I do want to get your thoughts, though, on some of the conversation that we saw during that press conference about ending the war in Ukraine. And at least for what right now seems to be a little bit of a lopsided negotiation, focusing primarily on the U.S. and Russia, without necessarily Ukraine's involvement. President Macron seemed to be certain that Zelensky would come to the table, and more importantly, that Europe would have a bigger role in this negotiating process. Based on your read out of the White House, is that real?
Well, we're getting kind of simultaneous negotiations that are happening here, Romaine. You are absolutely right that there is direct conversations taking place between the U.S. and Russia in regard to a peace deal. But there are also conversations taking place between the U.S., led by Treasury Secretary Scott Bessent, and Ukraine when it comes to a minerals deal. Essentially, and President Trump spoke about this in the press conference, the U.S. would like closer economic ties with the U.S. and payback for the money that the U.S. has provided Ukraine over what has now been 3 years of this war, going into a fourth through getting a share of their profits from minerals and things of that nature. And they say that closer economic relationship will act as a deterrent, ultimately, something that could keep the peace once peace is actually made between Russia and Ukraine. Now, the Europeans obviously have a different view of this, and President Macron spoke to this idea that Europe is willing to step up more in its own defense, that Europe and the UK, or France and the UK specifically, are willing to provide peacekeeping forces in order to maintain peace in Ukraine. But Macron did suggest they are going to need U.S. backing to do that, not necessarily troops on the ground, but other kinds of support. And providing that kind of support to Europe is not something that President Trump really seemed to agree to in this news conference. To use his exact words, he said the cost and burden of securing the peace must be borne by the nations of Europe, not alone by the United States. So the jury's still out on this one. And I would point out that the UK Prime Minister Keir Starmer is the next European leader to visit the White House. That's coming up on Thursday.
All right, we'll be keeping an eye on that. Kailey Leinz, the co-host of Bloomberg's Balance of Power. A closer look here at what's been going on in the White House. And speaking of which, we did not get a chance to talk about whatever's going to happen with U.S. Steel. Cleveland-Cliffs out with earnings right now. They make no mention of it in their press release. Those shares actually lower here in the after-hours trade after those fourth quarter numbers somewhat came a little bit light here, $4.3 billion in revenue. That's pretty much in line with what the street was looking for. But it talked a lot about here a slowdown from its auto customers here, saying that it was severely impacted in the fourth quarter by domestic auto production declines. So it does say that it expects that impact to actually be at a trough going forward here. No real estimates here other than saying that their CapEx will stay elevated at about $700 million on the year versus street estimates of about $685. The shares down about 4% here in the after-hours trade. Scarlett.
All right. In terms of what happened in the regular cash session, a late sell-off pushed the S&P 500 lower, falling below 6,000, falling below its 50-day moving average. And you can see the Mag 7 played a big role in that. The group down 1.4%. NVIDIA will be reporting results on Wednesday, so that's a big focal point. Microsoft was weaker after an analyst said the company canceled leases for U.S. data center capacity. So lots of questions over their CapEx and the level of spending that these companies have committed to so far. There was buying in treasuries. That was a reliable safe haven today. So the yield on the 10-year coming down 3 basis points to 4.39%, and remain a new record high for gold.
All right. We'll be back in a moment. This is The Close on Bloomberg. All right, for many black entrepreneurs out there, having investors that look like them can definitely go a long way. That's why black-owned investment firms like East Chop Capital want to expand their presence in the private equity space. That firm currently invests in at least 5 companies owned and operated by black founders. It's also the largest minority-led investment group in Uncle Nearest Whiskey, which is now valued at more than $1 billion. Let's bring in the co-founders and general partners of East Chop Capital, Calvin Butts Jr. and Carrington Carter. Let's start with Uncle Nearest, because since we showed it there, and we've had Fawn Weaver on the program a few times here, big fan of that. When we talk about finding those opportunities and finding sort of people like Fawn, where do you look for that? Do they come to you or do you go to them, Calvin?
Well, actually, Martha's Vineyard was the location where I first got a chance to connect with the brand. They were looking to host an event on the island, and we got a chance to host them in my home and got a chance to meet Fawn and Keith and hear their story, and ended up buying some early shares from one of their investors who happened to be my neighbor. And that led to us being involved in Series D and Series E. And now we're buying secondary shares and continuing to adjust her cap table with folks that look like us, which is very exciting.
I am curious, too. It's funny you kind of share that story, and it kind of is indicative of how a lot of deals get made here. It's not really necessarily in the boardroom. Sometimes it is in those social situations. And when we talk about the experience of black entrepreneurs and not necessarily having access to those types of social experience, to get that here, I guess in the environment we're in, and I'm going to pose this to you, Carrington, is that harder now?
I wouldn't say it's harder.
Yeah.
I think if you're actively seeking those opportunities, and there are ways to still be exposed to them. That's why it's important to be connected to your community, to be involved in groups like East Chop Capital. I'm also a mentor in Tulsa Techstars, which is the Tulsa cohort within the Techstars Accelerator, which gives access to opportunities of founders in various industries that are looking to grow their company. So I think if you're looking for those opportunities actively, then they are around to be found.
Carrington, you've said that you are pretty much industry agnostic when it comes to looking at potential investments, and you actually prefer more diversification. But I'm wondering, given the state of the economy, given where borrowing costs are right now, the political priorities that's been laid out, are there specific industries that are more promising right now than others?
Artificial intelligence is big. That continues to be transformative across a variety of industries. We've placed some bets in that space. There's a real estate investment company that we are excited about that leverages AI to make city planning and permit approvals a lot more efficient. There's some fintech companies that we've invested in as well. And to hedge on some of what's going on right now, we also have real estate development as a key part of our portfolio. And part of this multi-asset strategy is what's making us successful.
Are there any industries that just don't appeal to you right now at all?
That's a great question. I would say maybe media. Maybe media.
Ouch.
It's a complicated industry. Yeah. There's a lot going on right now. Yeah. There are ways to find opportunity in it, but us not being experts in media, we've kind of taken a step back.
All right, fair enough. I mean, trust me, we're well aware of all the issues going on in the media. But for those opportunities that you are finding, maybe we can talk a little bit more about real estate, as I know that's a big component of your portfolio right now. When we talk about real estate investment, a lot of it is about following trends in migration. Like we've seen a lot of, obviously, folks move from the Northeast down south. There's been a lot of talk about what's going on in the Sun Belt. Are there certain areas of the United States right now where you're finding more ample opportunities, Calvin?
Yeah, so we're definitely looking forward to looking at investment opportunities in the Southeast. You know, like you said, the migration of folks looking for warmer weather, the opportunities to work from home, and kind of the relaxed back to office environment that is still trying to figure itself out. There's a lot of folks still looking for opportunities to find better economies and cheaper land, cost of labor, and the opportunities exist in the Southeast for us. So we're looking at states like Alabama, Georgia, Mississippi, and we're trying to concentrate in those areas.
What's kind of the general time frame that you look to get a return on that? I'm talking specifically in the real estate space, because obviously these are sort of longer term trends that take a while to play out, Carrington.
Yeah, the real estate game, it's always been a long game, and we say it's just gotten much longer. If you think about the cost of materials going up, cost of land going up, that's why we like the South and Southeastern part of the country, because we see some favorable opportunities there. So we've certainly expanded our time frame kind of on the 10 to 15 year mark. And it's a great way for us to build generational wealth for our investors.
I am just curious, have those costs moderated at all? Because I know they went up a lot, of course, during the pandemic and shortly after that. And it seemed like they were kind of leveling off up until, recently. Are you concerned?
I would say it started to level off a little bit, but
Yeah.
then with talks of tariffs and whatnot, I mean, we're doing quite a bit of new construction in Florida, and our contractors are saying, hey, we need to order this before X, Y, and Z happens. So it certainly complicates the business, but with most businesses, it's important to be adaptable. And that's one of the key characteristics of being successful in business, and we found ways to do that.
Calvin, I know that as an angel investor, you probably look at the jockey rather than the horse, the visionary, the founder, as opposed to the business and the idea. So what's the common thread that all the founders you've invested in share? Is it a mindset? Is it a trait? Is it a specific background?
I think a lot of them are big dreamers, and they're doers as well. So Carrington and I both have big dreams, but we also get in there and do the work. When we invested in Alexis Ohanian, the founder of Reddit, he showed us that he was willing to do the work and connect to his port companies and provide resources for them. And he also invested in our first fund as well, so we were excited to have him. And then other folks like Andre Swatson and others, we've just gotten a chance to bet on these jockeys based on the great attitude they have towards what they're trying to accomplish, disrupt, change, better, et cetera. So we're very excited to kind of put energy and wind behind them.
Yeah, and so I am curious, so on that front then, so we talk about where the next big investments are. So I saw that you guys are a part of this new MLS team that's going to be at some point next year going to take shape in Connecticut here. Just talk about the investment there and why you decided to move into sports.
Well, it's MLS Next Pro, which is like a minor league team. So we decided that for multiple reasons. One, the opportunity to be in part of a real estate play right there on the waterfront in Bridgeport, Connecticut. So very exciting opportunity to be a part of that. As real estate guys, we understood what that could look like in the future. And then obviously soccer is one of the fastest growing sports and has kind of become America's sport. So a very exciting time to kind of be a part of that and see the wave of how it's engaging our youth onto our professional sports teams.
Does Roger Goodell know that that's America's sport now? You just gave him a heart attack.
I gave him a little bit of a scare there.
All right, Calvin, really appreciate your joining us. You too, Carrington. Thank you so much. Calvin Butts Jr. and Carrington Carter, co-founders of East Chop Capital.
All right, still ahead, we're going to set you up for what investors will have their eyes on over the next 24 hours, including some big earnings out of Home Depot. This is Bloomberg.
The housing market in the spotlight ahead of Home Depot's results, which are due tomorrow. Joining us now to discuss is Bloomberg's Jaewon Kang in Chicago. And Jaewon, of course, whatever Home Depot says about the housing market will be top front and center for investors. Can you give us a reminder of what Home Depot has said so far about housing and consumer demand?
Yeah, so far Home Depot has said, consumers have the means to spend, but are waiting until interest rates come down a little bit. And they've said, consumers are on the sidelines when it comes to bigger ticket items, homes, projects that typically need financing. And they've also said they expect to see more activity when mortgage rates drop closer to 6%.
So when we talk about this idea, though, of sort of when we start to see more meaningful growth out of this company, we talk about this trend of same-store sales declining, and whether that is indicative of something specific to Home Depot or whether it is about broader economic conditions, Jaewon, what do you think investors are going to really look for out of the earnings release and the conference call?
So I think one of the main things that investors will be looking out for is their forecast of sales for the upcoming year. Comparable sales, which is the key sales metric, is estimated to grow about 1.7% for the year, and that would reverse what's been many quarters of negative comp sales. And I think any color on the consumer housing demand will be really important. We're seeing a lot of macro uncertainties, whether it's consumer spending, tariffs, and investors are turning to companies like Home Depot and Walmart that reported last week for clues on sort of how to decipher various risks and challenges.
Yeah, and I'm glad you bring up tariffs. To what extent is this something that Home Depot will address head on? This idea that a lot of its merchandise is sourced from outside the U.S. and increased tariffs may mean that they'll have to pass the cost on to the consumer.
Yeah, so they've previously said, as it relates to tariffs, a lot of their products are sourced in the U.S. and that, like other retailers, they've really navigated through this environment for years now, and it's something that they're very, used to. So I think we'll hear more of that tomorrow and likely additional details.
I just want to kind of get your thoughts, though, Jaewon, on sort of the broader state of consumer spending overall. I mean, you had a great story in the Bloomberg terminal today about another big retailer, Walmart. And when we've looked at some of these earnings that we've gotten out of some of the retailers, and there's a few more big ones coming up this week and next beyond just Home Depot and Walmart, is there a thread that sort of binds all these companies together, or are all these going to be idiosyncratic types of earnings stories?
I think the commonality so far has been that consumers are still quite resilient. They are spending. When they see things that they find to be good value, they're opening, their wallets. When they find things that they think are, new and innovative, they are also spending on those things. It's just that generally they are still quite cautious, which is how they've been for quarters now. So I expect to hear more of that. Going forward, and we'll be looking out to see if there's any additional or new shifts that are coming out of the consumers.
One thing that we can also point to as well, and you know this from covering Walmart, is their expansion to advertising and the digital business. And I'm wondering if Home Depot is kind of making moves in, a strategic direction that kind of helps it rely less on the the consumer. For instance, the bulking up of its professional business, right?
Yeah, so the pro business and the professional customers, they tend to, be more interested in larger and more complex projects. So that's been an area that they have been really interested in. Lowe's has also been interested in expanding their footprint with the pros. As it relates to some of the digital and, newer businesses, they've given companies like Walmart, extra sort of cushion, and it's helped with their profits. It's helping them to invest in other areas of their operations, whether it's stores or wages. It's something that they see a lot of opportunities in.
All right, Jaewon Kang here. A nice look here at the retail sector as we await those earnings tomorrow morning out of Home Depot. A read potentially on consumer spending and, more importantly, on the housing and building markets. A few other things that investors will have their eyes on includes some earnings out of some other consumer-facing companies, including Keurig Dr. Pepper in the morning.
That's in the morning. And then in the afternoon, we're going to get another read on the consumer. So it's not just drinks, but also restaurants. Cava, it has been a high flyer, right? Up 162% in 2024. Instacart, but trading under the name Maple Bear, which, we still haven't really figured out why that is.
Yeah, so Instacart, we get those earnings as well. Cava, it'll be interesting also to see what we hear out of names like Caesars, Intuit, Lucid, and Workday. Those are your earnings, the main earnings we'll be keeping an eye on. We're also going to get some data on the housing sector, the FHFA's house price index at 9 a.m. Tomorrow. And we're also going to get a read on consumer confidence, Scarlett.
Yeah, read on consumer confidence. Expect inflation expectations to play a big role. We saw that from University of Michigan. Their 1-year outlook and the 5 to 10-year outlook certainly showed that people are anticipating the tariffs to play a role in price increases.
Yeah, and we don't always make a big deal out of shareholder meetings, but Apple's shareholder meeting kicks off at 11 a.m. Eastern time tomorrow. There are quite a few shareholder proposals that are making a lot of noise, including one regarding DEI and some others on some of its CapEx spending. It'll be interesting to see what they have to say.
Absolutely.
All right, we'll keep an eye on that and bring you all of that news as soon as we get it right here on The Close for all your market-moving action. For politics, stick around. Kailey Leinz and Joe Matthew are up next on Balance of Power right here on Bloomberg.